Hey everyone. It's a little early, I guess, on a Friday to do this. The market's still open. I may keep an eye on it a little bit, but um, I thought just put out this short marketing piece for Bison Insights and thought I'd talk about it for a minute. I saw a few things recently that were thought provoking and prompted this, in addition to just sort of normal reflection around how Bison Insights has done over the last year and sort of what I think is going on with it, as well as what I think might happen in the future. Thinking about some feedback that I've gotten on it, pushback, positive thoughts, and so on. So it feels timely, and it's a casual Friday, so thought I'd do this. And this is an um, open space. So if you don't mind in the chat, not sharing sort of specific tickers. One of the things, I guess I'll start with this because I've gotten a little pushback on it, is that I've shifted from, I used to share different stock ideas publicly in different formats, and I've shifted to exclusively sharing stock ideas outside of communication with clients of my day job, which is running an investment firm, which I'm not soliciting for here. Um, Outside of the sort of normal course disclosures to those clients, um, I've shifted away from disclosure of individual stocks virtually entirely over to Substack onto here onto Bison Insights. And so um, there's a lot of reasons for that. One of them is that it just was hard to remember who I told what to. There were stocks where I'd tell someone I was buying it and then it would double and then it would fall by 90%. And I would sell after it doubled. And then, let's say 3 years later it was down 90%. And you see someone at a cocktail party or a kid's birthday or whatever, and they say, "Hey, why'd you tell me about this thing that's down?" And it's like, don't even remember the name. It's, oh yeah, that thing. Well, I owned it and it did well, and then it did poorly. And when I did well, I sold it because I was in it for, X, Y, or Z reasons. And when those changed, I sold or it hit my target expectations, or, I just found something that I liked better or was different or so on. So partly it's to sort of address that sort of set of problems in terms of notification and information and things changing, but also um, it's helpful from a compliance perspective, where as my investment firms grows, fortunately, there's been good performance. Again, not a solicitation, but there's been good performance. It's been growing, and it's helpful, I think, from a compliance perspective, to have all of my comments on stocks from a public perspective in one spot. And so that's here, and that's generally behind the paywall. On rare occasion, I'll open a paywalled article publicly, usually for a specific sort of strategic reason, but generally behind the paywall. Um, and some of that's also just a business reason. I have an analyst who helps me. In terms of putting together these charts and some financial analysis and chasing down some of the diligence. I've shared 17 ideas so far in the last year, 15 of which are still live. So I've closed out 2 ideas, which did really well. And then subsequently, one of them went up more and then fell. And the other one subsequently, when I closed it out, went down. So you never know sort of what the impact is going to be of talking about something one direction or the other. And so far with those two, they had different directions, at least at first, but also a reminder of that first concern, where at least people know within within the paid subscriber community at Bison Insights, that X, Y, or Z idea that I shared, I'm no longer involved in, or at least no longer sort of maintaining as an active idea on Bison Insights. And so it's helpful to charge money for it to be able to fund the various costs, from time to compensation to various other things, to be able to keep it going. And it's not my day job, but it certainly doesn't hurt to we're in a capitalist society, and I think it's a sort of good way to do it. And then also, I have raised the price for Bison Insights over time for new subscribers, just because, one, the performance has been spectacular, and two, I like to be responsive to people. And I've been maybe too active on the chat. Maybe I should be a little less active there, but it's nice to be able to be active and responsive to people in a moderately timely manner. And that gets harder as there are more subscribers. And I think with the great performance and with some more awareness around Bison Insights. There's now well over 1,000 paid subscribers, for which I'm extremely thankful, but also very busy. And so it's one of the ways to navigate that is to price discriminate. And again, that just sort of gets back to the whole capitalist society thing. One of the best ways to navigate things, in my view, is to have market prices for them. And so I think I'm materially underpricing this publication. For some people, it might be a stretch, but I think for anyone that's deploying meaningful capital or particularly interested in the energy sector and the oil and gas industries, I think it's massively underpriced, and I just don't know of other places to go to find performance anywhere close to this or find these sorts of variant ideas. And that's really what I wanted to talk about here, which is I saw an advertisement for an energy fund that owns mid cap stocks with minimum size, I think, of $1 billion+ and minimum trading liquidity. And then I have a number of friends who are at various pod shops and other sort of big investment firms where they need companies that are $10 billion in market cap and even more trading liquidity. And for the most part, I don't write about that because that's not where the opportunities are, in my view, to massively outperform. And when I look at the performance for that investment fund, for example, that was advertising, they were very proud of a return that was much, much lower than the performance of Bison Insights, and frankly, not much better than their index or benchmark. And and then you look at these pod shops and they're not really trying to earn correlated returns. They're sort of playing a different game. But if they're having a good month, it's up 2% net because they're sort of shorting off their exposures and they have high transaction costs. And so if they have a net 2% month, if they have a net, let's say 15% year, it's spectacular. They're deploying huge amounts of money. They're trying to earn that sort of moderate return with essentially no losses. It's a very, very different game than investing as a value investor, trying to materially outperform the market over time. And I'm certainly not promising that I can do that in the future. I don't know. And there's a lot of risk and uncertainty that comes from investing. And there's a reality, which is that things can go up a lot, and the things that go up a lot can also go down a lot. So there's a lot of different caveats. That being said, there is an enormous advantage in investing in the places where these smart people are not competing. And there's a few different aspects of this. One is that it's very, very uneconomic for funds to show you this. And yes, I run a small investment firm, but frankly, I've chosen to keep it relatively small. I show higher performance volatility, partly because I invest in small cap stocks. And again, I don't think that's a brag. I think that's sort of the opposite. But the performance has been great. Again, not raising the money for it by talking about this or whatever, just trying to explain it. And it's not a revenue maximizing activity for me to do that. And my choice has always been to prefer return optimization to try to earn the highest possible returns rather than to solve for low volatility like the pod shops, or rather than to earn the highest management fees like some of the few remaining energy funds or whatever that are still out there. And so this is well known. And again, it's sort of scandalous that your stockbroker, frankly, stockbrokers for the most part just direct people over to index funds, which for the most part own large cap stocks, and they contribute even more to the relatively poor performance of large caps versus small caps with some quality selection. But the advisors won't really tell you this. They don't want to get sued. They don't want to get fired. The fund managers won't really tell you this because they want to go raise billions of dollars and go deploy it in large cap or mid cap or whatever stocks, so that way they can charge millions or tens of millions of dollars a year in management fees that are paid just for existing, not paid for outperformance. And so there's not really in the investment media, very unfortunately, seems captured. Even podcasts to a large extent are captured. I was listening to one podcast recently. I shared this on the chat, and this guy had very strong views on the Fed and talked about how the Federal Reserve Chairman was an idiot and doing all these things wrong. And he had very strong views on oil and on the stock market. And this guy, in my view, messed up. He has an investment research sort of firm, and then he also now has an ETF. And what's been fascinating is these folks that have these supposed great reputations on the research side, when you see their ETFs, it is fascinating because this guy, again, very, very strong views, outspoken. Towards the end of the interview, they were talking about what a great success he is and, how he balances his life, and was like sort of doing these weird victory laps. And his ETF has materially underperformed the market since inception. And so, again, there's just this weird dichotomy. That was a podcast. Normally, people think podcasts are less like that, but you look at the financial media and they really are playing for their sponsors, right? Really, it's a game of get eyeballs and sell eyeballs. And the eyeballs that they're selling, they're trying to sell to, again, investment firms and public companies and service providers, all of whom are playing the big company game and the big dollar game, not the return maximizing game. And so because of that, again, they focus on the largest companies with the most eyeballs, and everyone is piled in on this one game. And when everyone's on one side of the boat, it's pretty comfortable to be on the other side of the boat, at least for me. And so the remarkable thing is that in the context of all of this, the research is so clear. You can look at Fama French, which is famous for the efficient market hypothesis, which everyone rags on. All the value investors hate it. The quants hate it. Everyone hates it. And the amazing part is that they're known for the efficient market hypothesis, but people don't really understand it. It's not that they're saying that markets are efficient. Again, like I went to University of Chicago. I didn't study with them specifically, but I studied with folks that they've worked on papers with and so on. It's a misconception. People just don't understand Chicago school approaches towards theories and towards research. You come up with something like this to study the exceptions. And one of the big exceptions that they find is that small cap stocks outperform over long periods of time. And again, it's so strange, right? You think, oh, markets are efficient. People tell you that you should index. Not necessarily. If markets are efficient, maybe you should go to the spots in the market where you're more likely to outperform statistically, historically. And again, this time may be different. This time period may be different and so on, but over time, it's been pretty clear. Similar Stocks for the Long Run, a pivotal book by famous professor Jeremy Siegel at Wharton. I've actually been on a couple of radio shows with him a while ago. Really smart, interesting guy. I remember I was on a show once with him. I think it was like shortly after COVID, and he was very bullish stocks, and he got mocked aggressively for being bullish. Everyone said, oh, that's stupid. I can't remember if it was the Delta variant of COVID or something was happening. And people said, he's stupid. And Josh, you're stupid. Oil's going down. Stocks are going down. And, he wrote this book, Stocks for the Long Run. And here we are. The market's like doubled or something. Oil's up 3 or 4x from there. I was right. He was right. And the cynics were popular and wrong. And he pointed out that small cap stocks, not over short periods of time, maybe there are moments where they outperform, but over long periods of time, small caps materially outperform. And it's one of those things where, hey, if the market goes up 8% a year, 9% a year, why be greedy, right? Why take that risk? Well, if you compound it 15% a year, which I'm going off memory, I think that was around what he found for small caps over like 80 years versus compound at 8% or 10%, it's a whole different ballgame, right? You put in $1 million and you have $1 billion instead of having 50 or $100 million over whatever time frames. I'm not going to do that math live on here, but really, really different. AQR, same, but even better, because AQR points out that not only is there this efficient frontier, which you see from Fama and French, where you're statistically more likely to, and within sort of optimal market conditions, which means it's a persistent advantage, not over all periods, but most periods, to outperform owning small caps. And not only over the long run are you likely to compound value, which was Jeremy Siegel's addition to this, again, presented in a very easy to read, highly recommend Stocks for a Long Run, easy to read book, very simple, frankly, read the first chapter, last chapter, you'll get it. And then AQR found if you just add a quality advantage, if you find the ones that aren't going bankrupt, you do even better. And so people don't talk about this, and it's wild. I get all kinds of flack. Oh, this guy likes small companies. They call them all kinds of different names. In most cases, I found actually the folks that are most critical about this make their money from competing with small public companies, or they're trying to get you to go buy large companies, or they're associated in some way, again, in this sort of financial universe where there's this snowball of the large company guys delivering low returns and high fees. And it is just so interesting that the data is extremely supportive of investing in small cap stocks. And again, this is not an advice newsletter in the sense that I don't tell anyone specifically what to buy, but just purely tracking the returns of the ideas that I've shared from the unaffected price, so the day before price from when I published them, and then for the two that I closed out the day before price before closing them out. And again, one of them I closed out and went up another 50% with it a little bit. Another one I closed out and over time it's down, I don't know, 50% or something. Really, truly unaffected in my view. And you look at this and it's done really, really well. Consistent. Basically, this could be, and maybe I should write another book and go and no one will buy it because no one cares about small caps. But it's a big secret I think there was even a book. I think they talked about this, about how you shouldn't, use brokerage firms. You should use index funds or something. But called The Big Secret for the Small Investor. And I apologize if that author, I don't even know if they're still around, but for borrowing their phrase. But maybe I'll write the sequel to that. This could be the fourth chapter, which is you can find these things that do extraordinarily well. And there's no guarantees, and not all of them have done well, and some have done poorly, and some have done well. And it's been very important to me to be honest and open about the things that work and the things that don't, and share my best guess on what's working and why, and try to size things. And sizing is very challenging. I was on this fantastic podcast recently called Odds on Open. I was a huge fan. I was reaching out to the podcast host to try to understand some of the stuff that a couple of his guests had been talking about position sizing. He ended up having me on, which was a huge honor. And it's just so hard to figure out position sizing, but I've thrown my hat in the ring and I have some sizing in there too, which is contributing, actually possibly hurting, right? If I just equal weighted sizing on all those ideas, would have been a lot better. So, I guess it's consistent with those observations, but so far, so good, and maybe so great. And there's no guarantees that this will continue. And frankly, after periods of outperformance, one should reasonably expect mean reversion. So people get mad when I say this, but you should not expect, what as they say, trees don't grow to the sky. That being said, it's the same process and the same sort of stock selection approach. And it's very exciting, I think. It's pretty cool to be able to show this publicly and to have shown ideas. They're in writing, they're in people's email boxes, they're on bisoninsights.com, .info. And, it's been pretty fun. I talk about also, like, there aren't secrets in this. It's not a surprise which stocks are going to outperform. Cheap stocks that are making more money and paying off debt and buying back stock, they outperform. I mean, it's really not like it. I know it sounds crazy. And then also ones with, like hidden assets or whatever. And the stunning part is it's just not rocket science. A lot of this stuff is just basic security analysis in an area of the market that people, the combination of small, and then oil and gas is out of favor and undersized in allocations. And then, endowments and foundations and pensions are still not allocating to public oil and gas equities. So the folks that would arbitrage this aren't. And then there are folks arbitraging oil and gas stocks, but they're only going after the $10+ billion type companies because they're at, XYZ multi-strat, like a Citadel or a Point72 or whatever. Again, not them specifically, but all those guys have these energy pods, and they are helping get efficient pricing for stocks at large size, which again is just yet another reason to, I think, focus on some of these small companies. So anyway, it's been pretty fun to do, pretty rewarding to be able to share these ideas and have them work so well. And again, I just want to caution strongly. I mean, this has been a good year for oil and gas stocks, even though people were very, very pessimistic. People are still very pessimistic, so that's promising to me, but there's no guarantees. And then the one other thing I've done that I'm pretty proud of is had a number of different CEOs and CFOs come on and chat with me. And I've done those conversations mostly live on Substack, and people have gotten to ask questions live to CEOs of these companies. And I think it's been really, really productive. And it's been interesting because I think some folks actually have chosen to allocate differently than me. So Most subscribers, from what I can tell, are not just mirroring this set of ideas, which is perfect because I'm not your advisor. I'm sharing these ideas to help inform and educate. But there's a few folks that went and bought much larger positions in one company in particular that's doubled. That was a small position for me just because the stock was going up, and it's very hard for me to go buy stocks as they're going up. I'm working on it, but I'm not there yet. And we did this interview, and the CEO was very enthusiastic, and CEOs tend to be enthusiastic about their companies. I mean, this guy is different. His stock is up now 3,000% since he became CEO like 20 or 30 years ago. So he's done really, really well over a while. And, there's reasons to believe him. And he was really enthusiastic. And some people bought a lot of that stock, and they've done very, very well. And I own some of it, but a lot less. And it was a 2% position for the composite at the start. And now it's bigger because it's up a lot. But, it's been pretty fun to see sort of this process play out, and very rewarding to hear from folks hearing about this stuff. And it's been great to be able to share, these ideas with subscribers and share access to these, company managers with subscribers. And I'm really, really happy with how this has been going. And I was thinking about this and just thought I would hop on here and share these thoughts, and maybe I'll publish this. And I guess if anyone has any questions or thoughts, I'm happy to try to answer them if you want here. And if not, I might just close this up. Oh, I'm going to probably, so I still own Journey Energy. I've disclosed that previously elsewhere. I own it. I'm not recommending it. I may be releasing my original thesis on it here on Bison Insights from the paywall. I know I've talked about it previously, and I've talked about it in a couple of podcast appearances just because I had already talked about it before launching Bison Insights. And there's been some speculation on a potential buyout, which is not why I own the stock. And I have no idea if they get bought or not or whatever. And they did a divestiture, and I've shared my perspective on that divestiture with subscribers. And I think I'm going to share a short public article about them just because it's gotten more interest recently and there's been a lot of speculation. And I think I did call this right, where a month or so ago, they had some meaningful news and the stock didn't go up. And I thought it was wrong. And they didn't press release it. They just put it in their presentation. So it was in the public disclosure. And I thought it was very, very material. And the market didn't respond. And then 3 weeks later, the market responded. Now people are guessing that they're going to get bought out. I have no idea, but I know that the stock was way, way, way too cheap in the context of what was happening. And so again, I own it. I'm not recommending it. And I just figured I'd flag that I'm working on an article right now to share that's public on it. And again, the takeaway from that isn't to buy the stock or sell the stock. You should figure out what you want to do with your advisor and do your own diligence and so on. But I thought I'd flag it just in the context of my prior comments on essentially not disclosing ideas outside of the paid stuff for Bison Insights. And then the one other idea that I shared was also Ensign, which I had previously discussed on various podcasts, like I think, what is it, Odds on Open, or not that, with Amber Kenmar. I don't remember her the name of her podcast, but I talked about that and it had done really well, and it's pulled back a little recently, but I still own it and I like it. And those are the essentially two ideas that I think I've shared publicly out of the 17 that are that I've shared so far here on Bison Insights. There's a bunch more that I'm looking at and working on. There's a infrastructure company that's super interesting. Yes, sorry, In the Money. Yes, thank you, Alex. I appreciate it. And sorry, Amber, if you hear this. Just forgetful. I forget. I call my children by the wrong names all the time, so I apologize. And then let's see. So infrastructure company that looks super interesting, very mispriced, a international oil and gas producer that's very misunderstood, I think. There's this bear thesis on international natural gas that's very strange, that's getting disseminated, and that it looks like is holding down some of the equities, even though the European and Asian gas prices look like they're pretty resilient, at least relative to pre-war levels and pre-energy crisis in 21, 22 levels. And then There's a international oil producer that's really interesting that I've been looking at, and a couple others, Canadian producer, US producer, some other services companies. So there's a big sort of potential set of ideas for publication potentially coming up, and constantly finding new ideas. It is actually funny. I mentioned Journey and the stock went down. So for those of you that think, hey, I talk about something and therefore it goes up, I don't think that's what goes on at all. If anything, it might be the opposite. And really, it's that big. I think there's just this huge advantage over time in finding these small things, being able to evaluate them. I do have expertise in oil and gas. I focused on it for almost my entire career. I was chairman of the board of a small public E&P company and sold it in a hostile bid situation. So I know about some of these things and how to navigate them. I think that was actually a formative experience with me and made me, I think, a lot better investor over time, having dealt with a number of asset sales and managing a management team and dealing with budgeting and all kinds of other stuff. So yeah, interesting idea pipeline. I think lots of off the run stuff, and yeah, just in terms of setting expectations, like I would not expect that when I share an idea, it goes up because I share it. In many cases, there's been no impact. Sometimes these things have gone down after I've talked about them, and sometimes they've gone up after I've talked about them. And so I hope that no one's thinking that there's some specific advantage in terms of hearing about my ideas first, like the Trump Truth Social nonsense or whatever. Yeah, I think I'm going to close this up, and I appreciate you all for joining, and I hope to catch you on the next one, and hope you all have a great weekend. And if you happen to be, there's an energy conference in Denver this coming week. If you happen to be there, ping me, and make sure to come over and say hi. And again, none of this is an offer, solicitation, or recommendation. I do this just purely for informational and educational purposes. Sell Bison advanced access for 100,000 months. So unlike the president of the United States, there might be some recourse against me for doing that. So I did actually think about something along those lines when I saw that for a second. Looked into it. One thing I did think about, and I guess I'm curious about people's feedback if they think this makes sense, would be to offer some sort of light version. I do think generally people, again, this isn't specific advice to any individual, but I think the market allocation to energy stocks at 3% of the S&P 500, and then most financial advisors appear to not have, they'll have extra allocations to, let's say, technology and not to energy. So the net exposure that people have in most cases appears to actually be even lower than 3%. But the US GDP, energy contributes something like, what is it? I can't remember if it's GDP or corporate earnings, but something like 10 or 11%. So people are underexposed. So maybe in an effort to do that, I might go I might start like a Bison Insights Lite or something and charge, I don't know, $10 a month or whatever, just to make it very accessible. And then just have it just be the simplified version of ideas and have them come out like a month afterwards or something. But I don't know. I haven't gotten around to that, and I don't know. I feel a little bad doing that, just because of the disparate information flow. It's not really my style, but maybe it would make it sort of more accessible while maintaining the integrity of sort of the full Bison Insights service, which is at a much higher price point than that. So I'm not sure. I consider it, but I think it would be less offering front running as a service, which again just feels repugnant, and you can see people's responses to Trump for doing that on his social media, and more just offering sort of a much cheaper version with a very significant lag that's more oriented, even more oriented just to simplified education and maybe just encouraging broader energy exposure, just less about anyone's individual exposure and more just observing that the market is underexposed and individuals tend to be even more underexposed because of the nature of the setup of current sort of financial advisor incentives and funds and so on. And so, just encouraging, I think, sort of more awareness of the opportunity set as well as the misallocation I would observe broadly in stocks versus and the market versus energy stocks. Anyway, I'm going to close this up. Have a great day. Have a good weekend. Take care.